Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Coursera Inc. Annual Report. Coursera, a leading online learning platform, offers a wide range of education and skills training services globally. The company operates through two main segments, consumer and enterprise. Under the consumer segment, Coursera provides various products and services to individuals, including guided projects, courses, specializations, bachelor's and master's degrees, postgraduate diplomas, and certificates in fields such as business, computer science, technology, and data science. These offerings are available through several platforms, including Coursera.org for individuals and Coursera Plus. In addition to serving individuals, Coursera also caters to businesses and institutions through its enterprise segment. This includes customized training programs for employers, colleges and universities, organizations, and governments. Specifically, the company offers services such as Coursera for Business, Coursera for Campus, and Coursera for Government. Overall, Coursera's diverse range of products and services makes it a one-stop shop for anyone seeking online education and skills training, from individuals to large-scale institutions and organizations. Coursera Inc.'s stock price has experienced a significant decline in the past year, dropping by over 25.99%. Several news events have contributed to this decline between February 2025 and February 2026. One of the primary reasons for the drop was Coursera's weak fourth-quarter profitability forecast in October 2025. The company's guidance for adjusted EBITDA in Q4 fell short of consensus estimates, raising concerns about potential margin pressure. This news led to a 12.9% decline in stock price. The proposed merger with Udemy in December 2025 was another significant factor. Although the deal valued Coursera at approximately $2.5 billion, the all-stock nature of the agreement raised concerns among investors, leading to a 7.1% drop in shares. In February 2026, Coursera's full-year EBITDA margin guidance of 9% was lower than anticipated, despite better-than-expected Q4 revenue growth and initial 2026 revenue guidance. This led KeyBank to lower its price target on Coursera's stock, contributing to its trading near its 52-week low. Finally, Coursera's slower growth outlook in February 2026 further contributed to the decline in stock price. The company's forward guidance indicated slower user and revenue growth, alongside continued investment spending, prompting investors to reevaluate the stock's near-term trajectory. Coursera Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Coursera Inc. trades at a higher price-to-book ratio of 1.58 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 36% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company like Coursera can be categorized into several key areas. On the growth side, increased contract acquisition costs, deferred commissions, and content fees from partnerships have contributed to revenue expansion. Specifically, the Asia-Pacific region has seen significant growth, with a 32% increase in revenue from 2023 to 2025. In contrast, certain factors have led to revenue decline. Amortization of deferred commissions and partner fees into cost of revenue has been a contributing factor, as well as decreased revenue in regions such as Europe, Middle East, and Africa. The number of learners enrolled in consumer contracts with universities, tuition charged by universities, sales volume of single courses and subscriptions, and length and quantity of enterprise contracts have also impacted revenue growth or decline. Regional trends have played a significant role in revenue fluctuations, with the United States experiencing a 13% increase in revenue from 2023 to 2025. Conversely, Europe, Middle East, and Africa saw a 22% decrease in revenue over the same period. These regional variations highlight the importance of understanding local market dynamics when assessing revenue growth or decline. The financial performance of a company has undergone significant changes over the past few years. Initially, net income was negative, with losses totaling $51 million, $79.5 million, and $116.6 million for the years ended 2023-2025. However, there was an improvement in net income from a loss of $79.5 million to a loss of $51 million. This change can be attributed to cost reduction initiatives and increased efficiency, which led to an increase in net income by $2.3 million in 2025. Profit margins have also shown some improvement. Despite not achieving profit margins in any year, the accumulated deficit decreased from $911.2 million to $860.2 million as of December 31, 2025 and 2024. The gross profit margin improved from 53.4% to 54.7% in 2025, while non-GAAP gross profit margin increased from 91.2% to 102.1%. Additionally, non-GAAP net income margin rose from 14.7% to 16.2% in 2025. The reasons behind these changes are largely attributed to increased revenue and gross profit, which contributed to the improvement in net income and profit margins. Furthermore, lower content cost rates due to higher learner engagement in content created under new production arrangements with lower revenue share also played a significant role in improving profit margins. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the latest data, the company has achieved positive operating cash flow in 2025, with a net cash provided by operating activities of $108.7 million. This is a significant milestone for any business, as it demonstrates the company's capacity to cover its expenses and invest in growth initiatives without relying on external financing. The consistent confirmation of this figure across multiple pages of financial reports further reinforces the accuracy of this assessment. The analysis of the company's debt level and interest expenses reveals a mixed picture. While there are some fluctuations in specific areas, such as operating lease obligations and current liabilities, overall, the debt level does not appear to have changed significantly. However, interest expenses have increased slightly by $0.6 million annualized. This increase is notable, but it is essential to consider the broader context of the company's financial performance. Despite this slight rise in interest expenses, the company's investment policy focused on preserving capital suggests a cautious approach to debt management. The company's performance varied across different segments and regions. On the positive side, the enterprise segment showed significant growth with a 7% year-over-year increase in paid enterprise customers and an improved net retention rate. The consumer segment also performed well, achieving revenue growth of 10%, gross profit of $308.3 million, and a gross margin of 61.4%. Additionally, the commercial segment experienced stable revenue growth and consistent gross margins over 3 years. However, some segments and regions struggled to keep pace with the company's overall performance. International markets faced numerous challenges, including regulatory, economic, contractual, reputational, and political risks, which hindered their progress. The Russia market was particularly affected by sanctions, leading to a negative impact on the company's operations. Furthermore, the energy segment saw a decline in revenue from $41 million in the first year to $23 million in the second year. Certain segments also pose potential issues that need to be addressed. Content creators and learners may face liability for unauthorized duplication or use of third-party materials, while customers risk harming their reputation if they post inappropriate content. These challenges highlight the importance of implementing effective strategies to mitigate risks and ensure continued growth across all segments and regions. Coursera's management is optimistic about the company's outlook, driven by a simplified business model that focuses on serving adult learners at every stage with a broad set of offerings. To achieve long-term growth, Coursera aims to drive sustainable growth through targeted investments in content development, cloud infrastructure, and go-to-market capabilities. The company has identified key performance indicators, KPIs, such as net retention rate for paid enterprise customers and adjusted EBITDA margin to measure financial results and make strategic decisions. Management expects revenue growth of approximately 72% over the next 12 months, with sufficient liquidity to meet cash needs for at least the next 12 months. However, Coursera acknowledges potential risks and uncertainties, including cybersecurity incidents and litigation, which could have a material impact on its business strategy, results of operations, or financial condition. Despite these challenges, the company remains committed to maintaining its B Corp certification through rigorous standards of social and environmental performance, accountability, and transparency. Overall, Coursera's management is confident in the company's ability to drive long-term growth through targeted investments and strategic decisions, while prioritizing future investments in key areas and reducing expenses. The company's dividend policy has been consistent in its decision to not pay dividends to shareholders. According to various pages of the extracted summaries, there is no record of cash dividends being declared or paid by the company. This suggests that the company prefers to retain its earnings for business development and expansion purposes. However, when it comes to share buybacks, the company has taken a different approach. In 2023, the company approved a share repurchase program under which it repurchased 3.1 million shares for $36.7 million. This indicates that the company is willing to use its resources to purchase back its own shares, potentially benefiting existing shareholders by reducing the number of outstanding shares and increasing their ownership percentage. There are concerns about inventory buildup or supply chain disruption in the given context. These risks stem from difficulties in managing foreign business operations, which can lead to inventory buildup due to inefficient logistics and supply chain management. Additionally, fluctuations in currency exchange rates can further exacerbate these issues by making it challenging for companies to accurately forecast and manage their inventory levels. The increased financial accounting and reporting burdens also contribute to the risk of inventory buildup or supply chain disruption. This is because companies may struggle to keep up with the complex regulatory requirements, leading to delays and inefficiencies in their operations. As a result, they may be left with excess inventory that cannot be sold quickly enough, resulting in significant losses. While there is no explicit mention of inventory buildup or supply chain disruption on page 93, it does highlight the concept of inventory risk through recoupable advances paid to content creators. This suggests that companies are aware of the potential risks associated with inventory management and are taking steps to mitigate them by implementing measures such as advance payments. That concludes the financial summary for Coursera Inc. Feel free to comment below, and I will be happy to answer them when possible.